The big question after my last video is this: if most silver predictions fail, why do people keep believing them? Okay, that's question number one. Question number two, are all silver narratives wrong, or are some of them actually valid? Question number three, how do you tell the difference between a narrative that sounds good and a narrative that is actually true? Because here's the thing, I got a lot of comments after my 90-day tracking video. A lot of people said, okay, Stack Guy, you showed us what doesn't work, but what does work? What should we actually believe? Fair question. So today, we're going to do something different. We're going to break down the 5 silver narratives you hear constantly, the ones that sound incredibly compelling but keep failing to deliver. And then we're going to look at 2 narratives that actually have predictive power. I'm going to use something I call the narrative stress test. Okay? It's a framework for evaluating whether a story about silver is actually useful or whether it is just designed to make you feel something. Because that's the real issue here. Most silver content isn't designed to inform you. It's designed to activate you, to make you excited or scared, to keep you watching. And once you understand how that works, you can never unsee it. I'm the Stack Guy. Let's break this down. Before we look at specific narratives, let me explain the framework. The narrative stress test has 4 criteria. If a narrative fails any of these, it's probably not useful for making decisions. Criterion 1, falsifiability. Can the narrative be proven wrong? Is there a specific outcome that would demonstrate it's false? If a narrative can explain any outcome, silver goes up, it was right, silver goes down, it's manipulation, then it's unfalsifiable. And unfalsifiable narratives are useless for prediction. They might feel good, they might build community, but they can't help you time the market. Criterion 2, time specificity. Does the narrative include a time frame? Or is it eventually true, which means never accountable? Silver will hit $100 is not useful. Silver will hit $100 by end of 2025 is at least testable. Most narratives deliberately avoid time specificity because that would create accountability. Criterion 3, mechanism clarity. Does the narrative explain how the outcome happens? Not just that it will happen, but the specific chain of events. COMEX will break. Sounds compelling. But what does break mean? Default on deliveries, change the rules, declare force majeure? Without mechanism clarity, you can't evaluate probability. Criterion 4, historical base rate. Has this narrative been claimed before? If so, what happened? If the same narrative has failed multiple times, you need a specific reason why this time is different. Okay, 4 criteria: falsifiability, time specificity, mechanism clarity, historical base rate. Now let's stress test the 5 narratives you hear most often. The first narrative is the most popular in the silver space. COMEX is draining. You've heard this 1,000 times. The registered silver at COMEX is declining. Vaults are emptying. Soon there won't be enough silver to deliver. Price must explode. Let's stress test it. Falsifiability? Partial fail. Here's the problem. What does draining actually predict? If COMEX registered goes from 30 million ounces to 25 million, that's draining. But what's supposed to happen as a result? I've tracked this narrative for 2 years. COMEX registered has declined by over 60% since the 2021 peak. Silver is still trading in the same range. The narrative was technically true. Vaults did drain, but the predicted outcome, price explosion, didn't happen. So is the narrative falsified? Proponents say no. They say the drain is ongoing, the explosion is coming. But if declining inventory doesn't cause price increases, what would falsify the thesis? I can't find a clear answer. Time specificity, fail. When exactly will COMEX break? In 2021, I heard weeks away. In 2022, months away. In 2023, any day now. In 2024, still imminent. The timeline keeps extending, and every extension is explained as they're desperate to suppress it longer than expected. Okay, maybe. But then when is the deadline? If there's no deadline, there's no accountability. Mechanism, clarity, partial fail. Here's where it gets interesting. What happens when COMEX drains? Scenario A, COMEX defaults on physical delivery. This would be massive, but COMEX has never defaulted. And they have mechanisms to avoid it. Cash settlement, rule changes, eligible to registered transfers. Scenario B, premiums spike as physical becomes scarce. This has happened at times, but premiums came back down. Temporary premiums don't equal permanent price increases. Scenario C, paper price disconnects from physical price permanently. This would be significant, but it requires explaining why the paper market wouldn't simply adjust. The mechanism is unclear. Drain is described, but break is undefined. Historical base rate, fail. This narrative has been active since at least 2011. I can find forum posts from 13 years ago saying, COMEX is months from breaking. Silver was $40 then. It went to $14. COMEX didn't break. Does that mean it can never break? No. But it means the base rate for this prediction is 0 successes over 13 plus years of claims. Stress test result, 8.5 out of 4. Unreliable. Now, am I saying COMEX inventory data is meaningless? No, it's real data. It's interesting to watch. But the narrative built around it, that declining inventory predicts imminent price explosion, has no predictive track record. The data is real. The story is unproven. The second narrative. Shanghai is paying $5, $8, $10 more per ounce than Western markets. This proves that paper price is manipulated. Eventually, the real price must win. This one is emotionally compelling. You see the numbers. Shanghai, $94. COMEX, $84. That's a $10 difference. Something is clearly wrong. Let's stress test it. Falsifiability, partial pass. This narrative makes a testable claim. Western prices should converge toward Shanghai prices. If Shanghai is the real price, the fake paper price should eventually rise to meet it. We can actually check this. In 2023, there were several periods of significant Shanghai premiums. Did COMEX prices rise to meet them? Sometimes, partially, often no. Premiums appeared and disappeared without consistent price convergence. So the evidence is mixed. The narrative isn't completely unfalsifiable, but its predictions haven't reliably come true. Time specificity. Fail. When should convergence happen? Nobody says. It's always eventually or when the manipulation ends. There's no specific time frame, so every day that passes without convergence is just manipulation continuing. That's not a prediction. That's a hope with no expiration date. Mechanism. Clarity, partial pass. The mechanism story goes like this. Shanghai represents physical demand. COMEX represents paper speculation. Physical demand sets the true price. Paper manipulation suppresses the Western price. Eventually, physical reality overwhelms paper fiction. Okay, that's a coherent mechanism. The problem is the eventually part. What force actually compels convergence? If COMEX can continue paper settlement, if eligible silver can be converted to registered, if mine supply continues, what specifically forces the paper price higher? The mechanism is clear on the diagnosis, but vague on the resolution. Historical base rate, partial fail. Shanghai premiums have occurred multiple times over the past 5 years. Large premiums appeared in 2020, 2022, 2023, and 2024. Each time the narrative said, this is it. Each time, premiums eventually normalized without the predicted permanent price increase. Now, there have been periods where premiums preceded rallies, so it's not a zero base rate, but it's also not reliable. Sometimes it predicts moves, sometimes it doesn't. Stress test. Result, 1.5 out of 4, weak indicator. Shanghai premiums are real data. They indicate physical demand in China exceeds supply at current prices. That's meaningful information. But the narrative that premiums predict imminent Western price explosions is overstated. Premiums can persist. They can normalize without convergence. They're a data point, not a crystal ball. The third narrative is the foundation of the entire silver bull community. Silver is manipulated. One day the manipulation will end. When it does, price will explode to its true value. This narrative is special because it explains everything. Silver went up. Manipulation failed momentarily. Silver went down. Manipulation. Silver stayed flat. They're keeping it contained. Let's stress test it. Falsifiability. Complete fail. This is the most important point. What would prove that silver isn't manipulated? If silver goes up, you could say manipulation failed. If silver goes down, manipulation succeeded. If silver goes sideways, they're maintaining control. Every possible outcome confirms the thesis. That's the definition of unfalsifiable. Now, I want to be careful here. I'm not saying manipulation doesn't exist. There have been documented cases of precious metals manipulation. Banks have paid fines. Traders have been prosecuted. That's real. But manipulation exists is different from manipulation explains all price action. The first is proven. The second is unfalsifiable faith. Time specificity, fail. When will manipulation end? I've been watching this space for years. The answer is always soon. It was soon in 2011, soon in 2015, soon in 2020. It's soon in 2024. There's no specific end date because naming one would create accountability. And when the narrative is unfalsifiable, accountability is the enemy. Mechanism. Clarity, partial fail. How does manipulation work exactly? The usual explanation involves banks holding concentrated short positions, spoofing algorithms, paper supply overwhelming physical demand. Okay, those are mechanisms. But how does it end? What force overpowers the manipulators? If they can create unlimited paper silver, what stops them? If banks face fines that are tiny compared to profits, why would they stop? The manipulation mechanism is described. The liberation mechanism is vague. Historical base rate, fail. The manipulation will end. Narrative has been active for over 40 years, since the Hunt brothers squeeze in 1980. That's 4 decades of any day now. Has manipulation been exposed? Yes, occasionally. Has it ended? Demonstrably no. The base rate for manipulation ending is 0 over 40 plus years. Stress test result, 0 out of 4. Useless for prediction. This is the hardest one to say because the community is deeply attached to it. And look, I believe concentrated positions affect price. I believe the paper market is larger than logical. I believe the system has structural issues. But manipulation will end soon is not analysis. It's faith. It might be true eventually, but it can't be used to make decisions because it can never be proven wrong. The fourth narrative. Geopolitical crisis drives precious metals higher. War with Iran, silver explodes, Taiwan conflict. The fourth narrative. Geopolitical crisis drives precious metals higher. War with Iran, silver explodes, Taiwan conflict. Gold to $10,000, dollar collapse, $500 silver. This narrative has intuitive appeal. Precious metals are safe havens. Crisis increases uncertainty. Uncertainty drives people to safety. Therefore, crisis equals precious metals rally. Let's stress test it. Falsifiability. Pass. This one is actually testable. When specific crises occur, we can measure whether precious metals rise proportionally. If Iran war begins and silver drops, the narrative is falsified for that event. Time specificity. Partial pass. The narrative implies immediate causation. Crisis happens. Metals move. That's a time frame we can evaluate, even if it's short term. Mechanism. Clarity. Partial pass. The mechanism is coherent. Uncertainty increases. Investors seek safety. Demand for metals rises. Prices rise. That's a logical chain. The problem is that other mechanisms compete. Crisis can also cause liquidity crunch. Investors sell everything, including metals. Dollar strength, metals priced in dollars decline. Margin calls, forced selling across asset classes. So the mechanism exists, but isn't the only mechanism. Which mechanism dominates depends on the specific crisis. Historical base rate, mixed. Here's where data matters. Let's look at actual crises and silver response. COVID crash 2020. Silver dropped 30% plus initially, then rallied 140% plus over 18 months. Russia-Ukraine war 2022. Silver spiked briefly, then declined through most of 2022. Banking crisis 2023. Gold rallied, silver rallied, then both pulled back. Iran tensions 2024. Multiple spikes and reversals with no clear trend. The pattern is inconsistent. Sometimes crisis drives immediate rallies. Sometimes it causes crashes first. Sometimes the rally comes months later. Sometimes it doesn't come at all. Stress test result, 2 out of 4. Unreliable in short term. Reliable. The crisis, crossing silver narrative, has logical basis, but unreliable execution. Crisis can drive rallies. It can also cause crashes. The direction depends on factors the narrative ignores: liquidity, dollar dynamics, investor positioning. Using crisis headlines to time entries is gambling, not strategy. The fifth narrative, solar panels, EVs, technology. Industrial demand for silver is exploding. Supply can't keep up. Deficit is permanent. Price must rise. This is my favorite narrative to analyze because it's mostly true but often misapplied. Let's stress test it. Falsifiability, pass. We can measure industrial demand. We can measure supply. We can measure deficits. If demand data shows decline or supply shows significant increase, the narrative can be falsified. Time specificity, partial fail. Here's the issue. Industrial demand is growing. Supply is constrained. But when does this cause price explosion? The narrative implies now or soon, but deficits have existed for years without dramatic price response. The narrative is correct on fundamentals, but wrong on timing implications. Mechanism. Clarity, partial pass. The mechanism is straightforward. Demand exceeds supply. Deficit draws down inventories. Eventually supplies deplete. Scarcity forces price higher. The issue is eventually. The above-ground silver supply is large. Inventories can decline for years before scarcity bites. And if price rises significantly, recycling increases, new mines open, substitution occurs. The mechanism is real, but has more steps than usually presented. Historical base rate, mixed. Industrial demand narratives have existed since the solar boom began in earnest around 2015. That's nearly 10 years of demand explosion. Silver in 2015, 15. Silver in 2024, 28. That's an 87% increase over 9 years. Solid return, but not explosion. More importantly, the demand narrative predicted shortages that didn't materialize in the expected time frame. Deficits occurred. Price didn't respond proportionally. Stress test. Result, 2.5 out of 4. Valid, but mistimed. This is the most legitimate narrative in the silver space. Industrial demand is growing. Supply is constrained. Deficits are real. But, and this is important, being directionally correct doesn't mean timing is predictable. This narrative supports long-term bullishness. It doesn't tell you what happens next month. Okay, 5 narratives stress tested, none scored above 2.5 out of 4. That's uncomfortable. But here's the good news. There are narratives that do work. They're less exciting. They generate fewer clicks, but they have actual predictive power. Working narrative. Number 1, monetary debasement is structural. This narrative is simple. Governments and central banks are structurally incentivized to debase currency. Debt levels require inflation to be manageable. Precious metals are finite. Over long periods, finite assets outperform debased currencies. Let's stress test it. Falsifiability. Pass. If governments begin running surpluses, if central banks shrink balance sheets permanently, if debt to GDP ratios decline globally, the narrative is falsified. We can measure these variables. We can test the thesis. Time specificity. Partial pass. This narrative is explicitly long-term. It doesn't claim to predict next month. It claims that over 10, 20, 50-year horizons, monetary debasement continues. The time frame is long, but it's honest about being long. Mechanism. Clarity. Pass. The mechanism is clear and documented. 1. Governments accumulate debt. 2. Debt service becomes burdensome. The riders 3. Inflation reduces real debt burden. 4. Central banks accommodate with money creation. 5. Currency units multiply. 6. Fixed supply assets maintain purchasing power. This mechanism has played out repeatedly throughout history. It's not speculation. It's historical pattern. Historical base rate. Strong pass. Every fiat currency in history has lost purchasing power over time. Silver priced in dollars has risen from 0.29 Oz in 1900 to 28 Oz in 2024. That's 96x increase over 124 years, roughly keeping pace with monetary expansion. The base rate for precious metals preserve purchasing power over long periods is essentially 100% over centuries of data. Stress test. Result, 3.5 out of 4, reliable for long term. This narrative works because it makes falsifiable claims. It's honest about time frame. The mechanism is clear and historical. The base rate is extremely strong. The limitation, it tells you nothing about short-term price action. But that's honesty, not weakness. Silver is volatile. Position accordingly. This one sounds boring. It's not a prediction, it's a framework. The narrative, silver is historically one of the most volatile commodities. It can rise 100% plus in bull runs. It can fall 50% plus in corrections. This volatility is structural, not accidental. Therefore, position sizing matters more than timing. Let's stress test it. Falsifiability, pass. If silver becomes stable, say annual volatility under 10% for extended periods, this narrative is falsified. Time specificity, pass. The narrative doesn't claim to predict timing. It claims that volatility is persistent. You can measure this continuously. Mechanism, clarity, pass. Why is silver volatile? 1. Small market size, easy to move with flows. 2. Dual monetary industrial identity, conflicting drivers. 3. High leverage in futures markets, amplifies moves. 4. Emotional retail investor base, momentum chasers. These structural factors persist. Volatility persists. Historical base rate, strong pass. Silver volatility has been high for decades. 1980, peak $50, trough $10 same year, 80% drop. 2011, peak $49, dropped to $14 by 2015, 71% drop. 2020, peak $30, dropped to $12 in March, 60% drop. Rallied to $30 again. The pattern is consistent. Silver makes big moves in both directions. Stress test. Result, 4 out of 4, fully reliable. This narrative works because it's not a prediction, it's a framework. If you accept that silver is volatile, you don't bet what you can't afford to lose. Expect drawdowns as normal. Don't panic sell bottoms. Don't FOMO buy tops. Size positions for your risk tolerance. This narrative won't tell you when to buy, but it will keep you in the game long enough for the fundamentals to play out. Let me give you 5 practical principles based on what we've learned. Principle 1, Embrace the long-term narrative. Ignore short-term noise. Monetary debasement is real. It's structural. It's not changing. This is why I own silver, not because COMEX is about to break, not because Shanghai premiums predict next week, because over decades, precious metals preserve purchasing power. That's it. That's the thesis. Everything else is noise. Principle 2. Stop trying to time entries based on narratives. The 5 failed narratives all imply timing. COMEX draining means buy now. Shanghai premiums mean buy now. Manipulation ending means buy now. They're wrong. Not wrong about silver, wrong about timing. Nobody knows timing. Anyone who claims to is selling something. Principle 3. Position size for volatility. If you accept that silver can drop 50% at any time, you position accordingly. Never invest what you can't afford to lose. Never use leverage you can't survive. Expect drawdowns. The people who get destroyed in silver aren't wrong about the fundamentals. They're wrong about position sizing. Principle 4. Dollar cost average instead of timing. Since timing is impossible, remove it from the equation. Buy consistently over time. Sometimes you'll buy high. Sometimes you'll buy low. Over time, you'll average a reasonable entry. This isn't exciting. It doesn't get clicks, but it works. Principle 5. Separate entertainment from strategy. Watch Silver YouTube if you enjoy it. I do. The community is fun. The analysis is interesting. But don't make financial decisions based on it. Your strategy should be boring. Long-term thesis, consistent buying, appropriate position sizing. The content you watch should be separate from the decisions you make. Before I close, let me update my prediction tracker. Last video, I committed to logging every prediction publicly. So here's what I'm adding today. Prediction 1, silver will outperform cash, USD, over the next 5 years. Confidence, high. Prediction 2, at least one of the 5 failed narratives will be repeated in major silver content within 30 days with no acknowledgement of past failures. Confidence, extremely high. Prediction 3, silver volatility, measured by standard deviation of monthly returns, will remain above 5% annualized through 2025. Confidence, high. These are now logged. Check the tracker link in description. Hold me accountable. And notice what I'm not predicting. Price targets, specific timing, COMEX breaking, Shanghai convergence. I'm not predicting those because I don't know, and neither does anyone else. Let me summarize what we learned today. I stress tested the 5 most common silver narratives using 4 criteria: falsifiability, time specificity, mechanism clarity, and historical base rate. COMEX draining, 0.5 to 4. Data is real, story is unproven. Shanghai premiums, 1.54. Indicator, not predictor. Not manipulation ending, 0.04. Unfalsifiable faith. Crisis equals moon, 2.4. Unreliable in short term. Industrial demand, 2.5 to 4. Valid but mistimed. Then I presented 2 narratives that actually work. Monetary debasement, 3.5.4. Reliable for long-term holders. Volatility positioning, 4.4. Fully reliable framework. The difference between failed narratives and working narratives isn't about silver itself. Silver may well go to $100. It may go to $200. The fundamentals are strong. The difference is about honesty. Failed narratives promise timing they can't deliver. Working narratives acknowledge uncertainty and plan accordingly. I'm the stat guy. I'm bullish on silver for the long term. I'm skeptical of anyone who claims to know the short term. If that resonates with you, subscribe. If you prefer certainty and hype, there are other channels for that. I'll see you in the next one. Next video, I'm doing something I've never seen in this space, a 30-day accountability update. Every prediction I've made, reviewed publicly. Hits and misses. Prediction tracker link is in description. Add your own predictions if you want. Let's build a community that actually keeps score. See you next time.